In this lecture, we will cover the CFA Level 2 reading on mergers and acquisitions. This is a long reading, but it is relatively straightforward, and I think it is quite interesting. The context is set in the introduction, where the curriculum tells us about the Guidant Boston Scientific merger. And I'll also just give you a summary of that example so we set the context for this reading. In 2004, Johnson & Johnson tried to take over Guidant Corporation. So we have J&J, which is the acquirer. The target is this company called Guidant. J&J wanted to take over Guidant and they put in a price at which they'll buy. After that, what happened is that Guidant got into some trouble. So the product that they were selling, that had issues. So then J&J tried to reduce its price. So that discussion was going on with Guidant. Eventually, they started agreeing on some price. But then another player came into the mix. This is Boston Scientific. And Boston Scientific put in their bid. Eventually, Guidant was sold to Boston Scientific and at a price that was higher than what J&J had originally proposed. But what we will learn in this reading is how we come up with the value of this company that needs to be acquired. We'll also see that there are many different perspectives to consider when we talk about mergers and acquisitions. There is the perspective of the acquiring company, the perspective of the target company, there is the perspective of the regulator. So we will look at these various aspects. Let us start though with some basic definitions and classifications. You keep hearing the term mergers and acquisitions. We will start with the definition of an acquisition. An acquisition might refer to any of the following: the purchase of assets from another company, or the purchase of a definable segment of another entity. If you have an acquiring company, this might simply buy a business segment of another company. That's also called an acquisition. Or the purchase of an entire other company. So if company A is acquiring all of company T, then that is generally called a merger. In the terminology that we'll be using here, acquisition is the larger term. A merger is a subset of an acquisition. So in simple terms, a merger is the absorption of one company by another company. And even within mergers, we have different categories. You can have a statutory merger where one company ceases to exist. So if this is a statutory merger, then T will be absorbed into A and T will cease to exist as a legal entity. Another scenario is a subsidiary merger where company A acquires T and T continues to exist but as a subsidiary of company A. And then you can have a consolidation where you have two companies, let's say A and B, they merge into some new company. So these old names cease to exist and we have a new legal entity called N. Some more terminology: target versus acquirer. This is fairly self-evident and we'll keep using this terminology throughout the reading. The target company is the company that is being acquired. And finally, you will hear the term takeover or hostile transaction. Generally, when we say takeover, often the connotation is that it's a hostile takeover where the management doesn't want to be taken over. The opposite of that is a friendly transaction where the management team does not have an issue with being taken over. And we'll talk about this in more detail later. Another high-level remark I'll make before I move on is that the terminology depends on which accounting standard we are talking about or which country we are in. You might recall from FRA that we had somewhat similar terminology, but not exactly the same terminology. US GAAP draws the sort of distinction that we are talking about here, and this reading is largely a US-centric reading. So this terminology is US GAAP or general US terminology. IFRS does not draw a distinction between different kinds of mergers. So just keep in mind that when you are reading about mergers and acquisitions, just understand the context and understand what is going on. There will always be some sort of a target and some sort of an acquirer, and that's what matters. The classifications that I'll talk about on this slide are more testable in my opinion. You can have a merger which is referred to as a horizontal merger. In a horizontal merger, you have two companies from the same industry which are merging. And since they are similar companies, let's say that two auto companies merge to form a larger auto company, that will be called a horizontal merger. We'll talk about the motivations for different kinds of mergers later, but very briefly, the motivation behind a horizontal merger might be economies of scale, where when two companies combine, then they are trying to maybe reduce their average cost, or there might be increased market power because they have increased their collective market share and maybe will then have more pricing power. Another scenario is a vertical merger. In a vertical merger, you have two companies which are in different parts of the supply chain. So let's say that you have company A that sells to end customers and they buy a supplier. So this would be an example of a vertical merger, and this is backward integration where a company is going back in the supply chain and acquiring a company. They can also be forward integration where if you have a supply chain of companies, let's say that this company is a distributor, it goes and buys the other company that actually is retailing the product. So these are examples of vertical mergers where we could have backward integration or forward integration. Generally, the objective is to save costs, because clearly if you have two companies in the supply chain, each company is trying to make a margin. So if this combination happens, then at least in theory, the costs can be cut, and also then there is greater control of the supply chain. The third classification here is a conglomerate merger, where you have companies from different industries which combine. So if you have company A from the auto industry which combines with company B from the financial services industry, this merger would be referred to as a conglomerate merger. The general justification is that it diversifies the business. If you have time, then you can read through example 2, which talks about the history of US merger activity. I don't think this is overly testable, but it is interesting. As a general point, over the last century or so, mergers and acquisitions have come in waves, and that is what this example talks about. For example, there is the first wave in 1987 to 1904, so a substantial amount of merger activity. Then merger activity goes down, then again there was a lot of merger activity 1916 to 1929 and so on. So this is not a history lesson, it's just if you are interested you can read it. If you don't have time, then don't worry too much. Alright, next point is related to motives for mergers, and this is important. The first big motive is synergy, and this is a term that is used extensively when companies talk about mergers and acquisitions and when they justify a bid. The point here is that if you can combine two companies such that collectively they are worth more than the sum of the parts, then that is synergy. And what do I mean by that? If you have company A and company B, let's say A has sales of 100, B has sales of 200, and let's say that company A has total cost of 60 and company B has total cost of 180, just as an example. If these two companies combine such that the sales go up to 300, but the cost, instead of going to 240, the cost only increases to 200. Why? Because there might be some cost-cutting opportunities. So what has happened here is, by combining these two companies, we have managed to substantially increase our net profit. So this is one example of synergy. Another example of synergy would be on the revenue side. where if two companies combine, maybe they have greater market share. Because of greater market share, they might have more pricing power, so revenue might go up. There might also be cross-selling opportunities, because of which the unit sales go up. All of what I'm talking about here is collectively referred to as synergies. Next motive is growth. Sometimes companies cannot grow fast enough organically. Organically means that a company is itself trying to expand. The other option then is to acquire a smaller company. And this happens a lot in the technology sector, where a company like Oracle has been growing a lot over the last decade through acquisitions. This is called inorganic growth. Increasing market power, this is related to the synergy item, but one reason that a merger might take place is that in a given industry, if you have two medium-sized players combining, then they become a larger player in that industry, and as a larger player, they will have more market power. Acquiring unique capabilities and resources, you might have company A that acquires a target because this particular target has some unique capability that A does not have. And again, I use the Oracle example because I'm familiar with this. Recently, Oracle bought a company based in the southeast US, which focuses on telecom software. So Oracle did not have telecom software, but wanted to get into that specific area, and it went and bought a company. So it went after that company because of the unique capabilities offered by that company. Diversification, this is the reason used when a company goes and buys a completely different entity from a different industry, and the claim is made that now the overall group or the overall organization is more diversified. But generally, finance professors and finance textbooks do not like this, because the idea is if you are an investor, then you can diversify much more effectively by simply buying stocks of different companies. So this is given as a reason, it is a motive, but generally in finance circles it is frowned upon. Bootstrapping earnings, this is important, and this is actually explicitly mentioned in the learning objectives. Sometimes companies with high price earnings multiples acquire companies with lower price earnings multiples, and that creates an illusion of growth. It can be shown that the EPS goes up, and I'm going to, on the next slide, actually work through an example so you understand this well. Managers' personal incentives, this connects with the agency problem, where we know that generally managers' compensation is connected with the size of the organization that he runs. So you might have the CEO of a company who acquires another company so that he is now running a larger organization. Tax considerations, you might have a situation where an acquirer tries to acquire company T. Now here T has a double meaning. T is the target, but let's say that T is also a company that has substantial losses, and because of those losses, substantial tax-related credits. So what A might do is acquire T so that those tax credits can be used to reduce the tax bill of company A. But clearly, there might be some laws and regulations that prevent this from happening. However, it is a justification that is used at times. Unlocking hidden value. A scenario here might be that you have company A, which is a large pharmaceutical company, and company T is a small pharmaceutical company that is in some form of financial distress. Maybe the management team here is not very good, but the research department here is excellent, and they are sitting on some formulas that potentially could be extremely valuable. So that is the hidden value here, which let's say the acquirer recognizes, and it is to get that hidden value that A tries to acquire T. Finally, cross-border motivations, and there are several sub-bullets over here. Sometimes it might be difficult for company A to sell its product in another country. So what it can then do is acquire a company in the other country. You can have another scenario where you exploit market imperfections. An example there would be you have a company, a software company in the United States, and this is old news now, but let's say that company acquires a software house in India, where essentially the US based company then gets access to relatively low cost software developers. So that is another motivation. Sometimes technology transfer. Company A might have a particular technology which can be used effectively in another country only after acquiring companies over there, and so on. The point being that there are several cross-border motivations. Cross-border, just to make sure you get it, means that a company is acquiring another company in another country. Now, as I said, one of the motives was to bootstrap earnings. So what does that mean? We'll understand this through an example. Assume two companies are planning a merger. So A is the acquirer, T is the target, and A star is the post-merger company. The stock prices are given, EPS is given, and so on. Now, let's look at where this EPS of 4.2 comes from, and then let's also think about what the stock price will be after the merger and what will the PE ratio be after the merger. So I want you to think about this before I talk about it. So what is happening here? We have company A acquiring company T. If you look at the total value of company T, it is the stock price of 50 multiplied by total shares outstanding 50,000. So the total market value is 2.5 million. Given a stock price of 100, how many shares does company A need to issue in order to generate 2.5 million? The answer is it needs to issue 25,000 more shares. So that is 2.5 million divided by 100, which is 25,000. So this many new shares are issued, which means that in the new company now, this is the post-acquisition company, the number of shares goes up from 100,000 to 125,000. Now company T ceases to exist. The total earnings, 525,000, where did this come from? This is 400,000 from the original company plus 125 from the target company. Total earnings 525. So earnings per share then equal 525,000 over 125,000, which is 4.2. So notice that the earnings per share for company A actually went up when company A acquired company T. And this effect is called the bootstrapping effect. This is straight from the curriculum. A bootstrap effect is where earnings increase as a consequence of the merger transaction itself rather than because of resulting economic benefits of the combination. So we are not talking here about any economies of scale or any synergy. It's just the mechanical transaction is increasing the earnings per share. This effect occurs when the shares of the acquirer trade at a higher PE ratio than those of the target, and the acquirer's PE does not decline following the merger. Now the question is, what do you think the stock price should be post-merger? There are two possible scenarios. One is that the stock price remains 100 because no economic value has been added. The other might be to say that, look, we now have 125,000 shares and the EPS is this much. So we might use this EPS and we might say that, look, the PE of the company is 25. If we still use the 25 and 4.2, then what does the price of the share become? It then becomes 105. If the market is not smart, then this is what the share price will become. But generally in efficient markets, this will not happen. In efficient markets, the share price will remain the same because no economic value has been generated. And the PE ratio will simply be 100 divided by what? By 4.2, the new EPS, and the PE of the new company will be somewhere between 20 and 25. If you do the calculations, you should get a PE of 23.8. Alright, so just make sure you understand the bootstrapping effect out of this example. The next point to recognize is that if we think about an industry life cycle, then there will be different kinds of merger and acquisition activity through different stages of the cycle. And hopefully you have figured this out, that the CFA Institute likes life cycles, especially the industry life cycle. You saw this sort of an industry life cycle at level 1 in equity. So here are the different stages. The names of these stages might vary from book to book. In fact, at level 1, these stages had slightly different names, but the principle is the same. Now, in this early stage of an industry where generally the sales is slow because the industry is developing, here we tend to have conglomerate mergers and horizontal mergers. What are the motives? You have young companies, small companies trying to sell themselves to larger, more mature companies. So that is one situation. Or young companies may look to sell themselves to other companies that have more resources. So here we will have conglomerate mergers or horizontal mergers. Then in the rapid growth phase, this is where the industry is taking off. Here again, the two kinds of mergers are conglomerate mergers and horizontal mergers. Here, generally, you will not have vertical mergers. In this stage, the profitability is high. So what are companies after? Already we have explosive growth. So mergers may be undertaken to achieve economies of scale, and that will happen with both conglomerate mergers as well as with horizontal mergers. Then we have the mature growth phase. In this particular phase, you can have horizontal mergers as well as vertical mergers. Often over here, there are no conglomerate mergers. And then in this phase, stabilization and market maturity, the most common kinds of mergers are horizontal mergers. And then when the industry is in decline, then you have all sorts of mergers, horizontal mergers, vertical mergers, and conglomerates. Over the next few slides, what I have done is simply taken the text from example 4, which takes every stage in the life cycle, describes that stage, and then talks about the motives for merger in that particular stage, and then describes the types of mergers. What you essentially need to do is learn this, because the learning objectives explicitly want you to know this information. Moving now to transaction characteristics. I want to make sure you understand this term transaction. In this context, transaction simply means the transaction where an acquirer is taking over the target. What are the different forms of the acquisition? What is the method of payment? What is the mindset of the target management? That's what we will look at. Form of acquisition. Simplistically, the acquisition could be a stock purchase or asset purchases. In a stock purchase, the target shareholders receive compensation in exchange for their shares. In other words, what the acquirer is doing is going to the shareholders of the target company and buying from the shareholders. in an asset purchase, the acquirer is going to the company and buying the company assets, in a sense bypassing the shareholders. With a stock purchase, explicit shareholder approval is needed because by definition a shareholder is selling you shares, so they will only sell shares if they want to. That is the implicit approval. With asset purchases, shareholder approval might not be required. Why do we say might not? If the acquirer is trying to acquire most of the assets, then there might be some rules in the company charter that says that, look, if an acquiring company is effectively trying to buy 90% of the assets, then some sort of shareholder approval is required. On the other hand, there might be situations where the shareholder approval is not required. What about taxes? We will look at taxes from two perspectives. One is corporate taxes. In other words, the corporate taxes paid by the target company, and the other is taxes paid by shareholders. In terms of corporate taxes, with a stock purchase, there is no corporate level tax, but the shareholders of the target company will need to pay taxes based on capital gains. With an asset purchase, the target company pays taxes on capital gains. This is the capital gains on the assets. In other words, if the purchase price of the asset exceeds the book value of the asset, then obviously a tax needs to be paid. With an asset purchase, there is no direct tax consequence for the target company shareholders. And finally, liabilities. With a stock purchase, since the overall company is being bought, then the acquirer assumes the target's liabilities. With an asset purchase, by definition, since it is an asset purchase, the acquirer avoids taking on the liabilities. The next point related to the transaction is the method of payment. The payment can be a cash offering where the acquirer says to the target that, look, on a per share basis, I'll pay you $12. This is in cash. A securities offering, the most common kind of securities offering is where company A says to target shareholders that, look, for each share of yours, you will get 0.8 shares of the acquiring company. This 0.8 is called an exchange ratio. It is the number of shares of the acquirer's stock per share of the target. The cost for this acquisition is then equal to the following. It's the exchange ratio. So let's say that we are using 0.8 times the number of shares of the target. If the target is being acquired in its entirety, and the target has 100 million shares outstanding, then we'll multiply 0.8 by 100 million, multiplied by the value of the stock given to the shareholders. If the value of company A's stock is 10, then you multiply by 10. So this 0.8 into 100 million into 10 is the total cost incurred by company A to acquire company T. And we are going to see this in more detail in an example later. And finally, mixed offering is a combination of cash and securities. So company A might say to T that, look, we'll give you $6 per share cash, plus we will give you 0.4 shares of company A in exchange for every share of company T. Here is an example of a stock offering, and I want you to read this and solve it before listening to the solution. So here's what's going on. We have company DB, which is the acquirer, shares trade for $20. PMC, which is the target, shares trade for $15, and we have 1 million shares of PMC. We don't really need to know how many shares outstanding of DB for this particular example. The cost, as I discussed on the previous slide, is equal to the exchange ratio, which is 0.9. 0.9 refers to the number of shares of the acquirer for one share of the target, multiplied by 1 million because that is the number of shares of the target, multiplied by 20, which is the share price of the acquirer. when you do the calculation, you get 18 million. Do you think that PMC shareholders are happy here? They should be, because what is the market value of PMC before the acquisition? It is 15 into 1 million, which is 15 million. So PMC shareholders collectively are getting a premium of 3 million. If you take a particular shareholder, what is happening to her? So originally she owns 500 shares of PMC. So what is her net worth? It is 500 into 15, which is 750. Now, post acquisition, she is going to be better off, but how much better off? You can either look at the percentages from here, or you can say that, look, how many shares will she have after the acquisition? She is going to have 450 shares. And what is the share price? 20. So overall her worth goes up to 9,000. So clearly better off. This is the solution from the curriculum. Mindset of target management. Very simplistically, when you have mergers, either it's a friendly merger or a hostile merger. Just because, actually, let's understand what we mean by friendly merger. In a friendly merger, you have the acquirer who approaches the management team of the target company, and the management team is not averse to the merger. Now, this doesn't mean that they immediately merge. There is still a process that needs to be followed. There needs to be negotiation, because both parties, even though they want to merge, but they want to get the best deal. What management should be trying to do is get the best possible price out of this, and what the acquirer is trying to do is pay as little as possible. So clearly a negotiation needs to happen. Both companies will do some due diligence. Company A will try to study Company T's books in detail, study the business, and obviously this management team also will study Company A. Once they come to an agreement, they define this document called the definitive merger agreement, and this is the document that is then shared by the management team with the shareholders. What the management team will say to the shareholders is that we recommend the merger, and here are the proposed details of the merger. But obviously the approval will have to come from the shareholders. The details or the material facts are provided to shareholders in a document called the proxy statement. You've seen this term before. Proxy statement is used for many different purposes, but the key point is this is the document that goes to shareholders, and shareholders can then vote on whether or not to approve this merger. The other scenario is a hostile merger. Here the management team does not want the merger to happen. This is the management team of the target company. So what options does the acquirer have? One option is called a bear hug, where the merger proposal goes straight to the board and it does not go to the senior management team. Okay, so not the CEO, but the overall board. Another scenario is a tender offer, where the acquiring company goes straight to the shareholders and starts buying shares from the shareholders at a specific price. So for example, the current share price might be 20, and the acquiring firm goes to the shareholders and tries to buy the shares for $22. And finally, we can also have a proxy fight, where what the acquirer tries to do is have its own people be elected on the board of directors. So if the acquiring company can control the board, then the acquisition will become easier. Coming now to section 5, where we will talk about pre-takeover defense mechanisms and post-takeover defense mechanisms. Let's first take a look at several pre-takeover defense mechanisms. So these are mechanisms that companies can put in place to deter acquirers from taking over the company. One pre-offer takeover defense is a poison pill, and you have seen this at earlier levels. But when there is a poison pill provision that allows the issuance of target company shares at substantial discounts, and this makes it costly for the acquirer to take control. And within poison pill, there are two subcategories. There is a flip-in pill, which says that the target shareholders have rights to buy shares at a deep discount, but the acquirer does not have that right. So what happens here is substantial dilution of shares, which does not benefit the acquirer. In fact, it would hurt the acquirer. The other is a flip over pill, where target shareholders have a right to buy shares of the acquiring company at a significant discount. So this will deter acquirers from taking over the target company. Another defense mechanism is a poison put. Here, target bondholders have the right to sell or put the bond at a higher price. So the idea is this. This is the target company. The target company has issued bonds which are held by bondholders, and the poison put says that if an acquirer tries to take over this company, then the bondholders can redeem their bonds at a certain price, and typically that price will be larger than par. So why would that deter a potential acquirer? Because for the potential acquirer, the moment they start taking over this company, they will have to come up with the cash to pay off the bondholders. Another very practical strategy is to incorporate in target-friendly states. As I mentioned, this is a very US-centric reading, and in the US, states have their own rules and regulations related to companies, and it is generally perceived that Pennsylvania and Ohio are very target-friendly in the sense that the rules and regulations in those states make it difficult for an acquirer to take over the company. Continuing with pre-takeover defense mechanisms, staggered board of directors. Now this is interesting. When you have a board of directors, there needs to be an election. So if you have 9 members, the question is whether the election should be annual or staggered. Annual means that all 9 board members are up for election every year. Staggered would mean something like this, that in a given year you have 1, 2, and 3 up for election. In the next year you have 4, 5, and 6 up for election. The case for having a staggered board is that you cannot change all the board at the same time. As an investor or as a company that wants to take over the acquirer, what you would like to be able to do is in one election replace the whole board. But if you have this staggered system, then that in a sense is a bit of a takeover mechanism, because it will take 2-3 years for you to get your own friendly board in place. So just to make sure, having a staggered board is a defense mechanism. Restricted voting rights. In the corporate governance charter, there might be a provision which says that if a given shareholder starts owning more than 15% of the company, then that shareholder loses voting rights. Obviously, that's an issue for investors, but that is another defense mechanism. Super majority voting provision. This provision, if it is part of the corporate governance charter, might say something like this, that for a takeover to be approved, a super majority of 80% or more is needed. Fair price amendments. Now I would put fair price in quotes over here. Some corporate governance charters say that for a takeover to be successfully executed, the price must be fair. But then the question is, what is a fair price? And maybe the fair price is defined as the highest the stock price has been over the last 3 years. That's just an example. So if a company is currently priced at $20, the highest price over the last 3 years has been 35, and the bid comes in at 23. What management will say is that, look, the price has been as high as 35, a current offer of 23 is not quote unquote fair, so they say to the board that this should not be approved. Okay, now clearly this is subjective because currently the value is only 20, but this fair price amendment can also serve as a defense mechanism. Golden parachutes, this is a little debatable, but I'll just explain what it is. A golden parachute is where senior executives get handsome benefits when they are laid off because of a merger or acquisition. Moving now to post-takeover defense mechanisms. The simplest one is just say no. And why is this a defense? The point is that if you have an acquirer coming after a target and target says no, then acquirer knows that they have to fight. So the question is, do they really want to fight? Another is litigation. This is where the target files a lawsuit that if acquirer takes us over, then there will be some antitrust issues or whatever the reason might be. Generally, lawsuits do not necessarily work, but they are a delaying tactic. So file the lawsuit and then figure out what your strategy needs to be. Greenmail, this is a situation where you have a company that intends to acquire or wants to acquire, and let's say that this company has already bought 10% of the shares in company T. What the management of T then does is says to company A that, look, your shares in the market are worth $20, actually pay you $25 for these shares. So the acquirer is being offered a premium, it's almost like a bribe, with the condition that the acquirer will then not try to acquire the company. Share repurchase. If the acquirer wants to take over T, what T can start doing is buying its own shares in the open market, and if company T is buying at a relatively high price, that might send the share price up. So it will make it more expensive for company A to acquire. A related item is this increased leverage or leveraged recapitalization. The point here is that the target company might take on debt and use that debt to buy back shares. So what is happening there? A target company now has a higher level of debt, which again might discourage the acquiring company. So the reason you see increased leverage here is because the increased leverage could be used for share repurchase, and then this leverage recapitalization is a separate category if the level of debt being taken on is quite substantial. So these items will discourage an acquirer. Crown jewel defense. What happens here is, if you have a target company with several businesses or several segments, of which one or two segments are the star performers, then in order to make itself less attractive, when an acquirer comes over, target company T just sells the most attractive parts of its business. Once these are sold, then the acquirer will not be interested in T anymore. Hackman defense, this is a little silly and based on a computer game from long ago, where you have this little Pac-Man that eats things up that are much bigger than itself. So a Pac-Man defense is where a large acquirer comes to acquire T, and then T puts in an offer to buy A. This doesn't happen much in practice because if T makes a counter offer, then effectively it is ruling out many other defense mechanisms. So if T makes an offer for A, then it cannot file a lawsuit that there is any antitrust going on over here. White knight defense. In this situation, again, acquirer trying to take over T. What T then tries to do is find another friendly party to take over T. T is trying to create a bidding war over here. If this friendly party, the white knight, is putting in a bid and the acquirer is also trying to take over T, then the cost will increase substantially for A, and that might discourage A. White squire is similar. A squire is just a smaller version of a knight. So here what T tries to do is find a friendly party to take a substantial minority stake, and that might also discourage the acquirer. Now I have reproduced example 6 from the curriculum here. We have a particular company in the US called Engelhardt, and this example very nicely and briefly identifies several takeover defense mechanisms. And I want you to pause the video and read this, but take a look especially at these various takeover defense mechanisms in place. They have a poison pill, they have supermajority. They also talked about pursuing a recapitalization plan. Now, there is an interesting twist in this example that I want to highlight. Generally, in the context of corporate governance, we talk about the fact that these various defense mechanisms are actually not shareholder friendly. From a shareholder perspective, it would be nice if an acquirer can acquire the company and pay more than current market price. But this particular example gives us another scenario where the original takeover was at $37, and Engelhardt used these various defense mechanisms to convince the acquirer, BASF, to actually pay 39 per share. So these defense mechanisms were used for the benefit of shareholders. Now we move on to regulation. And you might remember from level 1 economics this indicator called the Herfindahl-Hirschman index. In the context of regulation, we will look at antitrust laws and security laws. But let's start with antitrust laws. Antitrust laws prohibit mergers and acquisitions that impede competition. The point is fairly simple, and just remember this fact. When we say antitrust, we are referring to competition. So obviously what the regulator wants is more competition, because more competition, as we've seen in economics, means that consumers get more at a lower price. Anytime the regulator believes that a particular merger or acquisition will make the market less competitive, then there might be some legal issues. But now the question is, how does the regulator figure out whether a particular transaction is substantial enough to block it? And at least the perspective that we look at is the Herfindahl-Hirschman index. Before I go to this particular table, I'll just remind you what the Herfindahl-Hirschman index was all about. The HHI is the sum of the squares of market share. If you have an extremely concentrated industry, the extreme case is a monopoly. With a monopoly, you have one company with 100% market share. So what is the square of 100? It is 10,000. So an HHI of 10,000 means that you are completely concentrated. If you have a highly competitive market, that means concentration is very low. Let's say each company there, the 100 biggest companies, have a market share of only 1%. So what is the HHI there? So 1 squared plus 1 squared plus 1 squared for the 100 companies is, let's say, 100. So note that if you have a industry where the HHI is relatively low, then the regulator will not worry too much about mergers and acquisitions in that industry. So what does the relatively low mean? You just need to remember the fact that anything less than 1,000 is considered relatively low. So any merger and acquisition activity in an industry where HHI is less than 1,000 does not even get on the regulator's radar. Then the next scenario is a moderately competitive industry or a moderately concentrated industry. That definition is between 1,000 and 1,800. If in this industry you have mergers and acquisitions where the HHI changes by 100 or more, then there is possible action from the regulator. In other words, in this region, if the HHI changes by only 40, then the regulator will not worry too much. But if the HHI changes by 300, then the regulator might take action. What if you have a concentrated industry? So already there is relatively low competition and HHI changes by 50 or more, then the regulator will take action. So we talked about antitrust laws. What about securities laws? Securities laws are intended to maintain fairness in merger activities and to maintain confidence in financial markets. All you really need to know is that there are certain rules and regulations that need to be followed for mergers and acquisitions. These rules and regulations will vary from country to country. In the US, there is, security law section 13D, which basically requires disclosure when a party acquires 5% or more of another company. The emphasis with security laws is disclosure. So everybody should be very clear about what is going on. So let's look at example 7 now. And this is fairly straightforward. It's straight out of level 1. If you have a company with 10 competitors and you are given the market shares, can you come up with the HHI for this particular industry? It should be straightforward. You simply take each of these numbers square and then you add it up. Then let's say that 2 and 3 merge. Then what will happen? Then will HHI go up or down? If 2 and 3 merge, you have a more concentrated industry and HHI will go up. So you can pause the video and actually do the calculation. And here is what you should get. In the pre-merger scenario, this is the HHI. In the post-merger, this is HHI. So the change is 400. Do you think there will be any antitrust action over here? So now, if you look at this 1450, so when 2 and 3 merge, we have a big jump of 400, and the post-merger HHI is greater than 1800. So this would most likely involve some regulatory activity. Whereas over here, we are less than 1800 and the jump is relatively small, so it is unlikely that there will be any antitrust activity over here.